Tesla makes billions every year, but what if I told you most people have no idea where that money actually comes from? Because the truth about Tesla's profits, it's not what Wall Street wants you to believe. And once you see this, you'll never look at Tesla the same way again. So let's talk about the myth. Everyone thinks Tesla is a car company, printing money from electric vehicle sales, dominating purely because of innovation. But here's the uncomfortable question. If Tesla is just a car company, why are its margins sometimes higher than companies that sell luxury vehicles? And why did it survive when almost every other startup collapsed? Something else is going on. Now let's break down the revenue. Tesla makes money from vehicle sales, regulatory credits, energy storage, services, and software, including full self-driving. But here's the twist. For years, Tesla made hundreds of millions, sometimes billions, from selling regulatory credits to other automakers. Here's how it works. Other car companies couldn't meet emissions rules, so they paid Tesla. That means at times, competitors helped fund Tesla's profitability. Let that sink in. Regulatory credits are almost pure margin. No factories, no steel, no shipping, just compliance money. There were quarters where, without those credits, Tesla would have barely been profitable. That's not fraud, it's legal, it's strategic. But it's not what most investors imagine when they think of car profits. Now here's the real game. Software. Tesla doesn't want to be valued like Ford. It wants to be valued like Apple. Full self-driving costs customers thousands of dollars. Once the software is built, each additional sale carries massive margins. If Tesla perfects autonomy, it stops being just a car company. It becomes a mobility platform, a robo-taxi network, a subscription empire. And that's where the real profit potential lies. Recently, Tesla has aggressively cut vehicle prices. Why? To dominate market share. But price cuts squeeze margins, so profits fluctuate. This creates volatility, and volatility creates headlines. But here's the deeper strategy. Tesla would rather win scale, crush competition, and lower production costs long-term than protect short-term profit margins. It's a war strategy. Now let's talk about the gigafactories. Tesla's gigafactories are vertically integrated. They control battery production, software, and manufacturing. This reduces dependency, but it also increases upfront risk. If demand slows, those factories are extremely expensive to operate. Tesla's profits are highly sensitive to production volume, raw material costs, and global demand shifts. It's powerful, but it's fragile. Most people ignore this next part. Tesla Energy. Powerwalls, megapacks, grid-scale storage. Energy revenue is growing fast, and margins are improving. If renewable infrastructure expands globally, Tesla's energy division could become a massive profit engine. And almost no retail investor talks about it. Here's something important. Tesla's stock trades on expectation, not just current profit. Investors price in artificial intelligence, robotics, self-driving technology, and energy dominance. So when profits dip, the market reacts dramatically. Because Tesla isn't valued like a car company. It's valued like the future. So what's the truth? The truth is Tesla's profits are real, but they are layered. Some come from cars, some came from regulatory credits. Some depend on software, some depend on energy growth. It's a hybrid business model, and its future profits depend heavily on execution. Not hype, execution. So here's the real question. Is Tesla a car company or the most misunderstood tech company in the world? Comment below. Overvalued or just getting started? And if you want more deep dives like this, subscribe. Because next week, we're breaking down how Nvidia is really making it at billions.